let's start very simple. The equity markets in China have been stuck in a range. Earnings didn't quite manage to push us out of that. What do you think needs to happen for equities to wake up, A-share market in China to wake up, and do you think that actually happens over the near term?
Well, I think in the near term, we're running out of catalyst. We're having a tightening, or well, at least a slowing down credit expansion, and also monetary policy is sort of not being normalized. Even though we still have targeted help for the SMEs and the smaller part of the economy, but I think the larger part, the heavyweight, the heavy index weight components for the Shanghai Com and also for the CSI, they're probably not getting a lot of credit help as they did last year. So I think as a result, even though earnings has been very positive, but you can see that the earnings strength has been really concentrated on the upstream cyclical sectors. And as a result, I think those sectors are performing very well. I think commodities is going banana. But I think for the rest of the market that is outside of that sector, they are performing less well because they're not getting credit help at the moment.
And to your point, is it too late, or is it too early, or just the right time to chase that rally in cyclicals, commodities, materials, when it comes to the equity market?
Yeah, we haven't seen this kind of strength for the past 10 years. I think even if you look at the cycle that began in 2009, and also the short economic cycle that began in early 2016, back then we also have a huge, strong bout of upward momentum in the commodity sector. But then even so, if you look at the relative price strength, if you look at many other indicators, and also the inventory level and the supply level, they are we're looking at a very different picture here. So, even though the commodity price has surged substantially, I think many, for example, iron ore has been more than double, copper as well. But I would say that, they have much further new highs ahead of them.
Okay, so that's one end of the spectrum, new highs there, further highs for some of those cyclicals. In terms of the much loved, or the previously much loved stocks, like the tech stocks here in the mainland, but also those consumer discretionary stocks like Kweichow Moutai, the valuations there, given the sell-off, looking more attractive now, Hao Hong?
Well, they're looking better. I think the tech sector's crowdedness has cooled down substantially. I think, the new money, when they're going into the market, they're chasing commodity sector and the cyclical sectors. And also, I think the tech sector is facing some headwind. I mean, the news headlines just saying that in China, you have the anti-monopoly investigation, and also in the US, you're facing regulatory headwind as well. So I think all those things is not helping. So I think as a result, even though they have cheapened substantially, it is still too early to be bottom fishing.
Now, you touched on the earnings picture. Our team at Bloomberg Intelligence pointing out that for the first quarter, EPS up more than 31% so far. They're suggesting, the team, that possibly that's as good as it gets this year. Does that align with your view on earnings?
I think if you look at the overall market, and also if you look at the overall economic growth, more likely than not, it's going to peak out in the second quarter. So I think, when this peak GDP growth being reflected in earnings, you're probably going to see a sort of earnings growth peak. So, but the absolute level, I mean, pay attention, the absolute level is still rising. All right. So, when you calculate your PE, you're probably going to still see a valuation multiple compression because you have higher earnings this time around. And also, I think, within the market, you're seeing uneven development, between sectors. For example, just now we mentioned cyclical upstream, cyclical sectors are doing very, very well. I think many of the companies' earnings has been more than double. We haven't seen this kind of earnings growth for years and years. But then at the same time, in the other part of the economy, even though the earnings are recovering, but the strength and momentum is much less than the upstream sectors. So as a result, you're seeing uneven pricing strengths in different parts of the market as well.
What are you seeing as far as the property sector is concerned, just the overall state of the industry and also the outlook for construction? Because I imagine that plays into things like earnings, demand for things like steel, for example. So, what are you seeing, Hao?
Yeah, I think the property sector has cheapened substantially, but then the backdrop really is that the government is tightening the regulation on property speculation. So this morning, for example, Shenzhen came up with a higher home mortgage rate, just to sort of, temper the speculation further that we're seeing in the city. So I wouldn't be surprised to see many other tier one cities would be doing more or less the same in the coming months. So I think as a result, property price has been very expensive in China now, and it's becoming less and less affordable for people. So I think, as a result, it's hard for me to see strong revenue and profit growth for property developers. So I think, we have better opportunities somewhere else in the market, but that is not to say that, the property developers will crash down, because they are trading on very cheap valuation. It's just that they have no positive catalyst for them, for their stock price to move higher.
Hao, I know you've been looking at the other cloud that overshadows the markets here, which is the fate of the asset manager Huarong. Have the credit markets priced this event in accurately, given the information we know so far? What opportunities has that opened up?
Well, I think, if you look at some of the Huarong's bond issues, they're trading at a 20-30% discount. I think earlier on, they're trading at about 80% discount to the face value, right? So I think at that point in time, one has to conclude that, because the default risk is still manageable, just that, they're not busy coming up with new positive news to resolve the situation. But 80% discount to face value is extreme. So I think at that point in time, we have to say that, the default risk is largely being priced in. I think extending to the overall market, I think because of the inflation picture is still on the rise, I think monetary policy isn't likely to be loosened anytime soon. So therefore, I think, the pressure on yields is going up, not down. So I think, the bond market, the junk bond yield, which is very sensitive to inflation and also to monetary policy, is not likely to do well. But then at the same time, because what you ask is on the default risk, the rise in the junk bond yield is not a reflection on the default risk, but more on the inflationary picture that we're seeing right now.
Yeah, and Hao, as a final question, an extension to that, since you talked about high yield, what does that mean for investment grade in China? Because we've seen those spreads tighten as, I guess, more people go into the names that they're more familiar with. Yeah,
I think, people want to take some more risk, because when you see commodity price rally, to such extent, and especially iron ore and rebar futures, for example, those are, very strong sentiment indicators for the overall market. Many people just look at the rebar futures. If the rebar futures goes up, they go to punt on risk. So I'm not surprised to see, there's some, risk taking in the junk bond sector. But then at the same time, there are probably better ways to put your money, which is the cyclical commodity sectors.